I've been instructed by the ICE that I am not allowed to display the LBMA gold and silver fixes upon my website as I don't have a license. Here is the ICE. It's the Intercontinental Exchange. That's where the LBMA prices come from. Why would they hide these? Well, if you are being caught committing a crime, if you're being charged with a crime, the very first thing you do is you gather up all the files and you head to the paper shredder and you shred them all and get rid of the evidence. Well, that's what they're trying to do, is get rid of the evidence so that people like Nick Laird can't do this great investigative reporting. This is just math. The red line is the price of gold. The black line is the price of gold if only the London hours were traded. In other words, from the AM fix throughout that trading day to the PM fix, if that was the only trading that goes on, and then you paste that to the previous night's close of the London trading only, what you end up with is gold went from 1971, it was at $35, and today it would be $2.24. If you only take the trading at the close of London when the rest of the world is trading, and you take those hours, the percentage change in price during those hours, and you paste it to the previous day's close of the percentage change of non-London trading hours. Everybody else in the rest of the world, you come up with $50,000 gold. Now, this is just little by little, day by day, bit by bit, but this criminal price suppression actually is the great opportunity that has been provided to the precious metals investor. They are losing control, and as they do, the price will explode. This is the metaphor of pushing down on a spring, and when you lose control, it's going to bounce a lot higher. And so this criminality from them is your great opportunity. Luke Groman, I want to thank Luke for this wonderful chart. The red line is the S&P 500. The blue line is the S&P 500 priced in gold, and the S&P 500 has lost 21% since August 15th, 1971. It's down 21% priced in gold. And, gold was $35 an ounce then. Solve Nuttig, I'm not sure how to, but 1 year ago today, this was September 19th, the Federal Trade Commission posted this warning saying anyone who tells you to withdraw money, that's currency, not money, and buy gold bars, which is money, to protect is a scammer. And here it is from the FTC, Federal Trade Commission. Did someone tell you to buy gold bars to protect your money? No, it's to convert your currency into money, and that protects your purchasing power. It's a scam. Well, let's see how well the FTC has protected everybody. Oh, let me see. Gold is more than $1,000 higher. We're in the 26s. It's $1,100 that they protected you from making on profit, which is a 45% return over that same time period. So, Geiger Capital. Gold stopped tracking U.S. real rates in 2022, and this is the 10-year Treasury inflation-protected security, the TIPS, so inflation-protected U.S. Treasuries, and it's a little bit different than the 10-year minus inflation, the real rates. But look at the correlation here between the price of gold and the 10-year inflation-protected Treasury. The correlation up to here is probably something like 0.97, 0.98. So 97, 98% the same. And then this divergence in 2022. Why? In 2022, the U.S. decided not just to sanction Russia for the invasion of the Ukraine, but to seize Russian assets and reserves. And that put all the world's central banks on notice that that America has become this lawless country. just basically violating the rules of the international monetary system and going ahead and seizing another country's assets just because we don't like what they do. This is the 10-year real rates versus gold. So it's the 10-year minus, and it's a little bit different. You didn't see this big dip in the other chart, but still the correlation is mind-bogglingly huge. And then this sudden divergence at the beginning of 2022. And what is very interesting is the spot gold versus total gold ETF holdings. It's not the beginning of 2022, but the end of 2022, beginning of 23, it diverges. And the correlation here is just absolutely spot on. And that means that it was the West driving the gold price back then. But something changed, and it is no longer the West. We've been dishoarding gold. We've been selling, while the rest of the world, somewhere else, central banks, including the rehypothecation, the dehypothecation, the unwinding of all of those gold leases might be part of this. I have no evidence, not saying that it is. I'm saying it's a theory. It might be part of the rise in the gold price, because as you unwind these things, there are fewer and fewer ounces of imaginary gold out there. And as you have fewer and fewer ounces in the same gold market with the same amount of cash in it, the price has to go up. And so I just find it interesting that these charts are all diverging at about the same time. And Spencer, Spencer says, the dollar has lost 50% of its value versus gold in the past 3 years. 50%. Understand where we are. You now live in a third world country. And boy, is he right. Now, Alan Greenspan once said, in the absence of the gold standard, there is no way to protect your savings from confiscation through inflation. That's from Alan Greenspan, and he is a traitor to his own beliefs because he then became Fed chairman and the greatest inflator in the history of the world to that point, only to be eclipsed by Ben Bernanke, who was then eclipsed by Jerome Powell. Jeffrey Gundlach, who runs an enormous bond fund, now says that he believes holding a 25% gold position isn't excessive. So here's the bond king recommending 25% gold. What do you think is going to happen? Then, I used this before, but Paulson says gold could hit $5,000 an ounce. This is just mainstream media stuff. How gold could one day hit $6,000 an ounce, according to J.P. Morgan. That was in May. Then, from Simon, he says gold is returning to the mainstream finance. J.P. Morgan accepts gold as collateral. Then, just a few days later, from Correlation Economics, J.P. Morgan knows. And this is their recommendations for your portfolio by asset class: equities, bonds, credit, currencies, commodities. Long gold, silver, and platinum. Platinum, I'll get to that in a minute. Short oil and base metals. Now, if you're going short oil and base metals, you think that there's some bad times coming in the economy. You think that there's going to be less demand for oil, less demand for base metals. Base metals is what you build cars, and houses use copper plumbing and wire and all sorts of things. So this means an economic slowdown or even a depression. This means crisis, long gold and silver. That this is where you want to protect everything. Platinum is a commodity. It's an industrial metal. It's basically a catalyst. In your catalytic converter in your car, there's platinum or palladium when platinum becomes too expensive. But platinum has never been money. It isn't money now, and it will never be money. Gold and silver have been money and the safe haven asset for 2,500 years. And when there's a crisis, which shorting oil and base metals says that they are expecting, people rush toward precious metals, gold and silver, not platinum, not palladium, not rhodium. They rush to gold and silver. So long gold and silver, I just don't understand why they would recommend platinum. Moving on, I used this in my silver update, but Bald Guy Money, I reported on this 2 weeks ago. The one that I was using is the one that he reported on 2 weeks earlier. The 60-40 portfolio is headed for the guillotine. A 20% allocation would blow all my forecasts out of the water. I was calling for an 8% allocation, which is 20% of the 40%. But what they want here, so this has the potential to be huge. No, way beyond huge. Astronomical. I mean, this is like light years stuff. Morgan Stanley CIO favors a 60-20-20 portfolio. So Morgan Stanley is recommending getting rid of 50% of your bonds. This is normally 60-40, 60% stocks, 40% bonds. Get rid of half of your bonds, 50%, instead of 20% of the 40%, and get rid of half of your bonds, 50%, and that 50% you allocate to gold, and you end up with a 60-20-20. The bond market is one of the biggest markets on earth. This is just absolutely astronomical.